Hello, this is Rich Canlione from CME Group Trading Floor. Today's segment is Syria issue diffused, equity rally renewed. Obviously what's in the headlines this morning and the last couple of days, but this morning particularly, Russia talks Syria into surrender of chem weapons. What that means is that Secretary of State Kerry and Russian Foreign Minister Lavrov hammer out a plan of removing those weapons. So what we've seen, particularly in the last couple of days and again today, world equity shorts that got in on the war threat are getting out and then some. So let's talk about what those mechanics were and what the criteria was that we saw that motivated some of those shorts. Obviously, we go back several weeks and the whole impact in the market was tapering. That brought the S&P futures down, if you will, back to an area of about 1642. That was on the 19th, I believe, just through the 50 DMA, 50-day moving average, that is, at that time. Syria issue took a foothold in the marketplace, took us down to approximately 1625 area, just through the 100 DMA, day moving average. Now, as we are in the expiration cycle, we all know that in the expiration cycle, a lot of times we get bid back up and those shorts are covering. So in the expiration talk out there is essentially between the $16.75 and the $17 strike. That's where a lot of the option premiums are written. So if we take a look at what we've seen as well in the last couple of days, based on the economic releases, we've also seen the 10-year reject a big area. That 10-year rejection was at 3% on 9/5/13. So the fixed income side, if you will, is kind of suggesting that the strength in the marketplace in terms of what we've seen in terms of the economic releases, particularly the jobs number, and if you go back to the jobs number on those revisions, the fixed income side, the 10-year at 3% rejection is telling you that perhaps the economic strength isn't there to really motivate the Fed to go ahead and start that tapering as soon as the marketplace has priced it in. So you're kind of getting a repricing of the marketplace in that 1675 to 1700 area in the S&Ps. So what's the trade on the table so that we can take advantage of that as we approach Q3 and as we approach the FOMC, which is a two-day meeting, mind you, next week, the 17th, Tuesday and Wednesday. Well, it seems like the thing to do at this point would be to go ahead and look at the end of the month, mini S&P, the end of September, $16.30, $17 strangle. That's trading for, you can buy that for approximately $500. It captures the range that we've seen, both inside of that 100-day moving average and the top side of the marketplace, which is everybody's strike price area of 1,700. So that would be the trade on the table going into the end of September in the Q3 expiration. Rich Canlione from CME Group Trading Floor signing off. Thank you.